Williams Sonoma stock has soared, and I looked at Williams Sonoma stock just a couple months ago and I said this thing is significantly undervalued. I felt that there would be a pretty decent push. There was almost a 50% push since that last video. What happens next with Williams Sonoma stock? I wanted to kind of break down the financials, what's going on with interest rates, and how that might affect Williams Sonoma stock. Fact is, probably not good news ahead, even though it has soared as much as it has. Interest rates are very likely to go higher. This will affect consumers. There will be less discretionary income, so your $135 set of three spatulas might not be on everybody's shopping list in the near future. Because of that, revenues for Williams Sonoma stock there is probably going to be much lower going forward, and this is a fear that a lot of analysts are starting to look at. Revenues decline, probably not going to hit their target goals. Same with earnings, and Williams Sonoma stock moves lower. Let me show you what I'm looking at. We're getting a bunch of data this week, especially on Friday, with inflation. And inflation's running hot. The Federal Reserve's 2% target rate simply is not going to be met. Now, they may just take a wait and see stance for quite some time, especially since we have a presidential election on November 5th, which is a Tuesday. Then the 6th and 7th is there's a 2-day meeting for the Federal Reserve. They may move then. Until then, they may sit there and just basically say, wow, inflation's really hot. Wow, inflation's really hot. Not going to hit our 2% target rate and do nothing about it, simply because they don't want to do anything in front of the presidential election. Given that, however, the stock market might continue to run hot because the economy is not going to be slowed down. But if the Federal Reserve does start talking up interest rates as much as they can, the 10-year Treasury yield would climb over 5% easily. Now all of a sudden which is trading at 4.6% right now, now all of a sudden that benchmark, the 10-year Treasury, is sitting over 5%. Your risk to reward ratio on investing in 10-year treasuries at 5% is pretty low, because the next possible move might be a small move by the Federal Reserve of a quarter or maybe a half a point. But then the Federal Reserve will say, we're probably there at that point and can start thinking about lowering interest rates in the near future. That means price would go up as yields go down on your treasury. Therefore, your risk is small, but that's your comparison to Williams Sonoma stock. WSM is the ticker symbol. So what's the downside risk to WSM? 50%. What's your downside risk to a treasury investment? You can lock in that 5%, 4.5%, 4.6% right now. Your downside is incredibly limited. And that's what's probably going to happen with a lot of stocks that we're looking at. So as these interest rates move higher, the yield that you would want to get out of any kind of investment, it needs to be higher as well. That's your starting point. But those interest rates moving higher affect consumers, and Williams Sonoma, Macy's, Restoration Hardware, companies like that are really going to feel that pinch. Let's break down some of Williams Sonoma's revenues. They saw a pretty decent jump in Q4 to 228. 2024 for Williams Sonoma, looking for 7.72, a slight decline from 2023. Then we move up again slightly in 2025. We'll see if they can hit that. And that's the thing. If interest rates have to go higher, will they hit these numbers? As it is right now, WSM, Williams Sonoma stock, trading where it is, I think it's at 285 right now. That would get you about a 5.3% yield considering projected earnings if Williams Sonoma can hit that 2024 target rate with revenue. Net margins, these guys are much higher than the broader stock market. Net margins for Williams Sonoma, 15.55%, but the broader market is only about 10 to 12.5% net margins, depending on the quarter. Williams Sonoma is outperforming, but that's also seasonality because this was over the Christmas break, the holiday season from the reporting. Projected earnings per share, 1531 is for 2024. I've seen some numbers kind of higher and lower. That's your average, 1531. And then what you do is you take that 1531, 285 is the price, your yield 5.37%. So if the 10-year Treasury yield is trading at 4.62%, which is the number I saw earlier today, 5.37% is a pretty good yield considering the future. Now, what can Williams Sonoma do with that? Of course, you get your dividends, but also what something a company would do is do buybacks or invest in other opportunities and expand the business itself. So you don't actually get the 1531, but the business does. Then they can do things with that, which drives shareholder value. So the 5.37%, that's pretty solid. But the risk could easily see $100 go away real fast if we start to continue to see inflation numbers really high and the 10-year pushes above 5%. I've been sort of jumping on board that there's a big move, a shift about to happen. I've been doing so over the past, say, 2 weeks. We've really seen inflation numbers nowhere near possible hitting the 2% rate for that the Federal Reserve is looking for, and I've been saying time and time again, we're not going to see rate cuts this year. I was saying that back in middle 2023. No, we're not there yet. We're not there yet. And everybody's pricing in 3 cuts for 2024. How about this? This isn't even a flyby. That the Federal Reserve is going to have to throw on the brakes even harder after the election, and because of that, they may have to choke out this economy, which could be catastrophic for stocks. Given that, what's your least risky investment opportunity? The downside risk to the 10-year is so small. The Federal Reserve eventually will choke out the growth it needs to choke out. We're at 3.7% unemployment rate. If we got up to 4.5%, that would probably be enough. And that's still a pretty solid economy at 4.5% unemployment rate. Given that, revenues decline for companies, so do profits, so do stocks. Williams Sonoma stock would go lower. But then the Federal Reserve would flip on interest rates. And if you bought in at a higher interest rate level, price is going to rise. I look at bonds right now as the least risky investment you can make. Equities, the complete opposite. That we're at all-time highs, just off those all-time highs. Sure, we might see stocks trickle a little bit higher because the Federal Reserve has their hands tied at this point with a presidential election. They're not going to want to rock that in any way whatsoever. So the economy might run hot for about 5 more months until they really start hammering things. But then stocks collapse. If you want to find written content on this, I actually did an article on my Substack. There's a link down below. Make sure to follow the link and sign up for the free email for my Substack. Also, if you're just finding my channel for the first time, make sure to hit the like and follow button. We'll see you in the next video.